Welcome to the Commercial Real Estate Mentorship Program. The advantages and disadvantages of strip shopping centers. The typical strip shopping center is that little neighborhood shop with a couple of stores, 2, 3, 4, 5, 6, 7, 8 in the neighborhood. There are over 66,000 strip shopping centers in the United States. They're also known as neighborhood centers or community centers. And they're typical stores with the parking right in front of it, and you walk in the store and you go there, and that's fine. It's not a mall. It's not a major mall or a major large regional shopping center. It's a neighborhood center. They're traditionally open air, not enclosed. An arrangement with a strip mall includes a row of 3 to 12 establishments. Now, this is a pretty upscale looking one, but it's still a strip shopping center because it's not part of a mall. Now, the neighborhood centers range from 5,000 square feet to 100,000 square feet. And they serve customers within about a 3-mile, occasionally up to 5-mile radius. They're serving the neighborhood. That's what they're doing. The key investment for success with strip shopping centers is having several businesses which keep the customers coming back on a regular basis. That could be a restaurant, and that could be something where they're coming back on a regular basis, which you want to keep the traffic coming in. That's the whole point, on a regular basis. The lessees may pay the owner a bonus percentage rent, $1.50, $2 a square foot, and basically if the sales volume gets higher, then they'll pay a bonus, or what's called percentage rent. It's not necessarily as common as you would find in a big major shopping center, but it's certainly common here. It may be at a lower level percentage-wise. You can get all or partial financing because it is a locally owned entity. It is not a big company. It is not a bunch of major manufacturers, major office buildings, major anybody. It's usually just mom and pop stores. So the tenants are not major credit tenants. And many times, because so many of these small shopping centers are just managed by the owners, they don't have professional management, which may present an opportunity for them to get out of the day-to-day stuff. A disproportionate number of the owners of these things are managing themselves, and they may not want to continue to do that because they're dealing with local mom-and-pop businesses. It's not major corporations. It's not as bad as dealing with a bunch of individual residents in a lower neighborhood. I'm not saying that. But it's basically mom and pop and all the travails of individual small businesses. If they're sick and tired of being sick and tired, they may be interested in getting out of the deal. And all or partial financing may help that be a reality for you. The practical investment option for smaller commercial real estate investors. Many times a first-time buyer of commercial real estate will buy an apartment building, a small apartment building, or a small strip shopping center. With 66,000 of them available, there's a boatload of inventory. Absolutely, positively. And it's not as daunting as a major office building or a 300,000 square foot shopping mall, which is way out of your first-time buyer's ability to cope with it. The tenants pay the rent and they pay the common area maintenance, which means the driveways, the parking lot, or whatever it is, and they may pay you a percentage rent. That's the deal where if their sales volume goes above a certain number, you get a percentage of that volume above, let's say, $100,000 a month. You get 2, 3, 4, 5%. If it doesn't go over that, you don't get it. It's a nice kicker to get. It's very nice when you got them regularly coming in a big shopping center, but it's a nice kicker here when they pay the maintenance outside. They're not paying triple net leases, not paying the property taxes, they're not paying the insurance, but they are paying the common area maintenance, and that's certainly a help, right? The length of leases are shorter than the large malls or office buildings or any of those kinds of things, and it makes it easier, so that's a two-edged sword. One, you don't have this continuity of income guaranteed to you under a long-term lease, 3, 5, 7, 10 years. But also, as the rents are going up, as they are, it'd be easier to reposition yourself and get higher rates on the tenants you have, better terms, maybe throw in a percentage rent, maybe not throw in a percentage, maybe just raise the rent from $1.59 a square foot to $1.95 per square foot and get more per square foot. You could reposition your product with new tenants or with higher rate tenants and increase the cash flow. It is a great opportunity to reposition the property. It's not as good as having the long-term steady income from credit tenants, but if you're going to be dealing with less than credit tenants and you might have some volatility there, it'd be nice to reposition it and get a better return. Absolutely. Strip shopping centers involve less competition from large investors. The larger investors are going for the big turnkey deals, triple net office buildings, industrial buildings where they're getting steady big credit tenants, or an apartment building big enough to have property management where they don't have to deal with it. The strip shopping centers usually involve mom and pop management, mom and pop tenants. So that's not what the larger investors are going for. Despite the fact there's 66,000 of them, some of those are going to move hands. But if you have a chance to move them, then you can do it and buy one. A significant portion of strip shopping centers are locally owned and often owned by less experienced commercial real estate investors. This makes sense. The mom and pop owners of a strip shopping center live in the area. They have local tenants. They have a local beauty parlor or a local convenience store or a local restaurant or coffee shop. And they're dealing with mom and pop tenants. So that is a significant portion of the inventory. Frankly, they're easier to manage than a big shopping center because you have your storefront, it's right there, and the bottom line is you can charge less rent than the shopping center is going to charge them, which means someone who wants to rent your facility could get in for a lower price point. Well, that's cool. That may be helpful in terms of replacing tenants, putting a new tenant in there. See the sign in the window there? Yeah, something's going on. Economic development assistance is available sometimes for improvements, infrastructure, or maybe facade, because the local area would like to have these retail establishments be more vibrant and bring in more tax revenue, because that's part of the revenue which a county and a state operate on, because it is property taxes and it is sales tax that drive the engine for a lot of municipal governments. They may offer development assistance to develop, expand, modify for improvements, tenant improvements, do some added infrastructure. They may do the better streets or do something for the neighborhood. Or they may just flat give you a facade grant, $5,000, $10,000 to clean up the exterior. That's the facade. The exterior of the store to make it look better and more attractive. Well, you could take a grant, and that would be fine. You get $5,000, $10,000, tweak the front of the paste to make it look better. Maybe they'll get more volume and you'll have a happier tenant and they'll think you've added value. And it didn't even come into your pocket. That's a grant. That's awesome. Frequently less seasonal and fluctuating than maybe large shopping centers. Depends on the big purchases on Black Friday and Christmas and other holidays. Because this is day-to-day, not major purchases. This is going to the little convenience store, going to the local Starbucks, or going to a local restaurant. It's a local thing. It's not as seasonally trapped as they are in the larger malls. Property taxes may be reduced on the property because of the sales tax generated by the retail business. A TIF is a tax incentive program they have if you encourage people to do things there, and they can see that the property taxes, if they were waived, held in abeyance, or canceled, that they could have someone come in and be a retail tenant, and they could get steady streams of sales tax revenue. So many times they'll trade the sales tax revenue coming from the tenants to help out the landlord. And since you're not getting triple net, the tenant doesn't benefit, but you sure do if your property taxes are reduced, or maybe even your income taxes are reduced or eliminated. All those things are possible. We see the ads all the time from states and communities that they have incentive programs. They're real, and they're very effective in helping you particularly reposition a property. Disadvantages. When doing your due diligence, it is important to do it thoroughly because you're dealing with not with credit tenants. You're dealing with mom and pop businesses. What's the stability of that income? What's the stability of the possible percentage rent? Or is there any? These are things you need to know. You need to find out what the options are. Are these tenants all month to month? That would be problematic. If they're longer-term leases and they're making their payments and they're paying their CAM and so forth, that's all good. But you better find out the real financial details. This is not a hope and a dream deal. This is making an intelligent, informed business decision based on the financial facts, economic effects, and the reality of the tenants. The tenants tend to be smaller businesses with less financial strength. They're not credit tenants. It's the mom and pops, the salt of the earth, the people that create all the jobs in America, the small businesses. But it's not a credit tenant. It's just not going to be, in all probability. An empty storefront is pretty obvious. Store closing, going out of business, vacant, dark, no signage, nothing. It's obvious. Retail shopping can fluctuate based on the local economy and the national economy for that, and local employment. If a major company closes, that's going to affect local day-to-day business. It'll affect the economy in general. The small businesses could be hit on a small retail shopping center. With fewer tenants, 1, 2 vacancies hit the impact so much faster. That whole reverse the thing where you said if you had an apartment building with 20 units, you have a 5% risk. If you have 2 tenants out in an 8-tenant building, you're 25% vacant, right in front of the world. That can quickly affect your cash flow, the operation, the details, and if you lose a tenant who is generating a lot of the foot traffic and a lot of the traffic coming in, that may affect the whole shopping center because the other was a draw for your other tenants, and if they're gone, that is not good. It's not good for you, obviously. But an effective property manager can overcome almost all those disadvantages. If they're competent and capable to be able to market your property and present it in the right light and position you for success, then you can turn around this property. And obviously, turning around a property of this nature is a way to really add value. You're not buying a big cash-flowing entity. You're buying an opportunity for you to reposition it, raise the tenants, raise the rents, provide a better-looking facade, do the things you need to make it look better. And a good property manager can and should be able to do that for you. Position you to get the tenants you need, making sure that the tenant improvements, if you do any, are in light of what makes economic sense. Because if you're putting out money, you want to get a higher return. And they'd be able to get you that return. If you're putting $5,000, $10,000 in tenant improvements, you better recoup that over the next 3 years or so. That would be smart. If you have $15,000 out, you better recoup an extra $5,000 a year for 3 years. I'm not sure they're going to be here for 5. If you want to be real conservative, make it pay back in 1 year or 2. These are all things an effective professional property manager could do. You're going to have to find someone who's a hands-on person because they'd like to have a bigger facility. But if they're getting 10%, which is the normal, if they increase the rent, they're going to vote themselves a raise. This is the way it works. Is it worth it? Absolutely. It's a great way to start. It's hands-on. It really is, and it always will be. This is what it's all about, helping you become an informed, intelligent, commercial real estate investor. Take care.